wish there was an investing strategy that allowed me to use stock market crashes to my advantage while still making positive returns while the markets ride. Wait! I've got it!
How's it going, everybody? It is me, Mr. Drake, as noisy as ever. If you're one of my subscribers, thank you so much for the support. I appreciate every single one of you. And if you're new to the channel, don't be a stranger, subscribe and find me on Instagram. You may remember 2 weeks ago, we looked at the high risk, high reward prospect of single stock investing. And last week, we took steps to make our investments more secure by investing in index funds. Well, this week, I want to take some of that fear that beginner stock market investors still feel and turn it into excitement using 2 big Ds. That's because I want to show you how to super simplify your investing strategy and get great results, all while limiting your risk as much as possible. This strategy relies on 2 key components and my twist on them. The first is from the book Intelligent Investor by Benjamin Graham, and the second is from Money, Master the Game by Tony Robbins. The big flaw with stock market investing is, of course, the risk proposition. You have the opportunity to make better returns in the stock market than you would by saving in a savings account, but you also run the risk of making lower returns than a savings account, or potentially even making a loss. Especially when events like the 2008 financial crisis take many retirement portfolios and essentially cut them in half, it is easy to see why people panic. And when an event like the 2008 crash happens, a lot of money gets pulled from the stock market, both by personal investors but also by institutional investors. A lot of this money has to go somewhere, and there are a number of safe havens that people will flock to when they're trying to get through a bad season in the stock market. This introduces us to Big D number 1. Bonds, certain types of industries, and strong, reliable industries have previously been safe havens during market turbulence. That's not to say that these will always be the safe havens in the future, but I will guarantee there will always be a safe haven for investors to move their money to if they feel anxious or unsure about the future of the stock market. The difficult thing is knowing what that safe haven will be. Owning an asset before it becomes a safe haven is going to buffer against any potential losses you may experience. This is because as the value of your stock asset lowers, the value of your safe haven asset will continue to grow. You want to diversify as much as you can using funds, because you'll need to diversify across industries, countries, and even different types of investment. Diversification will allow you to better protect against a big loss in one of your investments. Though it may have a negative impact on your good years by a couple of percent, it could potentially turn a 20% loss into only a 5% loss. And when this difference is compounded over the years, that will make a huge impact on your future wealth. The amount of each type of investment that you own will depend on how aggressively you're chasing higher returns. I'm quite comfortable with risk in my current circumstances, so at the moment I only have about 40% of my invested capital outside of investing. If you're uncomfortable with risk, or you're over the age of 50 where you have less time to recover from a big loss, decreasing your exposure to stocks will potentially lower your returns, but it will also lower the potential chance of a big loss. Whereas increasing your exposure to stocks could increase your potential returns, but it could also increase the potential impact of a negative return in the stock market. For a frame of reference, have a look at the all-weather portfolio by Ray Dalio, which since 1972 has had annual returns of 9.5% and only lost money 5 years out of over 40, and its worst year was a 4.2% loss. Don't forget, we saw huge stock market crashes in 2000 and 2008, both of which had double-digit losses. Always seek multiple sources of information on diversification and act based on your own judgment from your research. Many people who want to invest in the stock market but put it off do so because they worry the day after they invest their money the world economy is going to collapse and they lose every penny. For a long time I shared that fear until I read The Intelligent Investor, and it shared a concept with me: the second big D. Dollar cost averaging is another method that helps you reduce the risk of investing by spreading out your payments over time. This way you won't lose everything overnight, but you also get the opportunity to massively capitalize if the stock market does take a turn for the worse. I have my own addition to dollar cost averaging, which I'll explain in a minute. But first, let's see how it works. If you had £1,200 and you invested it all immediately, you would be 100% exposed to the upside and downside of the market that you're invested in. If 2 days later that market was to take a 20% loss, you also would lose 20%. With dollar cost averaging, you spread the investment out evenly over time. So on day one, instead of investing £1,200, you would invest £100. By investing £100, you are about 8% exposed to the market that you've invested in. So if after a couple of days that market was to lose 20%, you would only lose about 1.5% of your £1,200. Then each month you deposit another £100, you slowly over time increase your exposure to that market. Dollar cost averaging is typically done monthly, but it could also be done daily, weekly, or even every other month. Here's a few examples of how dollar cost averaging could protect you from massive losses, but may also cost you some positive returns. On the screen you should see a chart showing a 6-month bear market and a 6-month bull market. It ends roughly equal to where it starts. £1,200 up front would have lost a lot of value in the first 6 months, but restored it over time to end up back at roughly the same value it started. Dollar cost averaging over a year would mean through the first 6 months you're able to buy more with the same amount of money, and over the second 6 months you'll be recouping your losses much faster to end up with a profit over the year. The opposite also applies for the other way round, however, so a 6-month bull market followed by a 6-month bear market that ends at a roughly similar value would see you making a loss. This next chart shows a 12-month consistent bull market. £1,200 up front would see you gain 100% of the upside, while dollar cost averaging would result in you gaining about half of the upside because over the year you're able to buy less each month with the same money. Again, the opposite applies for a 12-month bear market, where both ways you will make a loss, but in dollar cost averaging you will significantly reduce your losses. Now just imagine if you were to combine the portfolio that's permanently ready for trouble with progressively building your capital investment over time, taking advantage of corrections and recessions along the way. It's almost perfect, but I feel that with my finishing touch, it's the most exciting opportunity to build your investments with massive success. Within most investment platforms, you'll be required to make a deposit from a personal account, and the money is used within the platform to purchase your investments. When you make a deposit, that money goes into your available balance, and I made a decision soon after investing that I was never going to let my available balance be any less than 20% of my total platform value. I call this my discount bonus pot. At the moment, I have about £700 in my discount bonus pot, and its sole mission is to be ready at a moment's notice to take advantage of any discounted investment. Whether that investment's been on a 6-hour, 6-day, or even a 6-month correction, my discount bonus pot is there to buy things when they get cheap. The obvious example would be to buy when the market experiences massive lows like the recession in 2008, but those type of events don't happen very often. I look out for sharp drops in the investments I believe in, like when the S&P 500 dropped a bit near the end of 2018. So far, I've been able to buy near the 1-year low in all 4 of my ETFs, which has definitely contributed towards the returns I've made. So there you have it. The 2 big D's are dollar cost averaging and diversification, and the secret D is my discount bonus pot. Between the 3 of these, I hope to minimise my potential losses over the next decade, all the while taking advantage when an investment that I believe in is going cheap. I'll be keeping my Instagram semi-regularly updated about my investing results, and I look forward to seeing how my portfolio does over the next 10 years and how well I'm able to do following this strategy. That's it from today's video. I hope that you enjoyed it and got something useful from it, and hopefully I've been able to send you a little bit of love from Cornwall. I'll be back from my break this weekend, and I'll be back on your screens on Wednesday. But until then, stay cash flow strong, turn your wages into wealth. I'll see you in a few days. All the best, guys. Whether you want to learn more about investing or passive income, I got your back. Just subscribe.